Hey Douglas, how you doing today, brother?
Man, I'm doing good, man. How
I
you
got a
doing?
question. I'm good, man. I have a question for you.
Okay.
Listen, I've heard a lot about this generational wealth thing, especially in the realm of real estate. I mean, how do one have a real estate that you can leave for generations to come after you? And I know the market is volatile at the moment, up and down and all of that. Shed a little light on this thing for me, will you please?
Yeah, sure, man. Because a lot of times the media, the government, and the banks, they're very, very interested in your family's wealth, and they've brainwashed so many people to think that just buying real estate creates generational wealth. It's great investment, yes, but does it really build generational wealth? Two things you got to look at when it comes to access to money. The first thing is I got to be able to pull money out when I need it. It has to be liquid, and two, tax free. When I leave property to my kids, is it tax free? Or would the kids have to pay property tax? And if you're transferring properties to your kids, there's a lot of taxes involved in that as well. But the best vehicle that somebody can use that nobody ever talks about? Casual life insurance. And now here's the deal. Casual life insurance is just like real estate. What do you mean that it's just like real estate? Well, let's take an example of real estate worth 500,000 and you're paying 1,000 a month. The bank splits it in two. $700 goes towards the interest, $300 goes towards the principal to reduce that $500,000 principal of the loan that you owe, which gives you a $300 equity immediately. Now that's 12 grand a year. That's $3,600 in equity that you have for that year. But here's the problem. If you want to access that equity, you have to get permission from the bank. But when we flip it to life insurance, if I put a $500,000 life insurance on myself, first of all, it's less expensive than real estate, but we're going to keep it simple. Let's say it's the same $1,000. Well, out of that $1,000, $500 of that goes towards the insurance company because they're protecting you for $500,000. The other $500 goes towards the interest that you're going to earn inside the insurance policy. So there's two interests. With the bank, it's simple interest. With the money you're earning in insurance, is compounding interest. So the first interest that goes to the bank goes to the bank. The second interest that goes to the insurance company, that you have in your insurance policy, comes to you and you're earning compounding interest. And now the policy starts appreciating. Now you can make extra payment in your life insurance policy, just like you can make extra payment on your mortgage. But why pay extra on your mortgage? You're not earning interest on that extra. So I'd rather pay the extra in my life insurance. Why is that? Because I'm able to access it fast. So in the same example, if I put another $1,000 in the life insurance, now that's $1,500 that's earning compounding interest, and that I could access to buy more properties. But here's the flip side. When the person dies and they have this real estate, guess what? The insurance will pay out first and give the family $500,000 tax-free plus equity that the policy has, depending on how the agent designed it. So they end up getting more than the $500,000. They might end up getting $800,000. They might end up getting $1,000,000 tax-free, and they could use that $1,000,000 to continue paying on the real estate mortgage if there's one, or use it to make the house look pretty so they could sell it, or give them time to have structures in place that will allow them to sell that property and pay zero capital gain tax. There's ways to do that. Hope that helps.
Oh my God, this is huge.
Awesome.
Thanks, Doug. Appreciate you.